All right. Good morning, Doug. Today, we're going to talk about some big investment mistakes we both have made and what we've learned from it, because we've talked about some great successes we've had, but I think the lessons are often learned in the failures. But first, I want to address a couple things a couple of news items that have come up recently. One is that yesterday I made an error, and when I suggested that the congressman who thought that if you moved everyone on one side of the island of Guam, that it might tip over. I suggested that was Louis Gohmert, who is a Republican, but it was actually Hank Johnson, who's a Democrat. And people were very upset about that, getting that wrong. But in fact, the reason I think I got that wrong is because there's a lot of idiot statements that come out of these people's mouths all the time. And Louis Gohmert recently said something about, that asks a BLM person if maybe they could alter the moon's orbit in some way to reduce climate change. So, it's this sort of thinking, I guess, it's kind of the same.
I know, and altering the moon's orbit to alter climate change. I mean, it's even more stupid if it's possible than tipping over the island of Guam. So, an understandable error. And all these people are like interchangeable parts in a faulty machine. They're all capable of saying things like that.
It does seem that way, and I think one of the big point of all of it is that, in my mind, about these congressmen and senators is they just, they win these popularity contests within these small geographic areas, and that's how they get elected to Congress. But then, it seems very clear they don't really know what's going on, because like that they're just befuddled by the challenges that face them in many ways. Like whenever they have these tech executives in front of them, in front of a Senate committee, these guys, it's like they don't know what email is. It's like some of these Congress people and senators. I mean, they just don't. They're totally outclassed, in terms of the knowledge about what's going on in the world, and totally inept, I think.
And not only is it a terminal lack of knowledge, but it's a complete and total absence of critical thinking, or the ability to critically think.
So, yeah, more importantly,
further proof that the situation is hopeless. But one thing that was very amusing, and is a little bit along these lines, is Gary North, who I've got to point out to our listeners, you're in for a treat next week, because we're going to have Gary on there, who is on with us. He's an absolutely world-class scholar, especially when it comes to history and economics. So he sent me something. I don't know if you saw this too from a separate source, that there's an article in The Onion, which we'll have to reference, in 2011, about the US breaking up with Afghanistan and slipping out in the middle of the night, the way someone might break up a relationship and we'll always love you, but this isn't working, and so forth. And that's exactly what the US did at Bagram airbase. It's funny. Life imitating art.
It really is. The headlines, there's a headline in, I guess it's Reuters or something, but that it's almost exactly the same as the Onion article from 2011, that they slip out in the dead of night without even alerting the commander of the base that was taking over that they were going. And then, of course, the Taliban swoops in, and they left all these, up armored Humvees and like these crates of mortar rounds and tons of stuff that they just left there to sort of rearm the Taliban. I don't know. It's incredibly, the whole thing, we never should have been there, obviously, at all. But it's deeply irresponsible, I think, to just like, we can't pack up the mortars and take them with us. We're just going to leave them there. It's weird.
Well, it cost billions of dollars to get them there, and maybe they're figuring, well, why spend billions more to get them out? But the amount of money and material, the amount of material that's going to be left in Afghanistan after the last US soldier. And of course, the Taliban is definitely going to take over that country right away.
Yep. Seems like they're already on the march. It's like they didn't even wait until, it's like they didn't even wait until the U.S. was fully removed from the country before they started, making advancements. Yeah.
But then again, who cares? Because the American government is supposed to believe in democracy. And it's clear that the democratic answer for the Afghans is the Taliban or something like that. So they're getting what they want. So, and who cares? What are they going to do with all this military junk? Invade the country next door? That's not going to happen either. You're just going to go back to tribal warfare. So it's just, the whole thing is a joke.
It is. It is. Okay. Well, let's get into some investment mistakes. And someone specifically asked us about this because we talked about some successes in the past. And, I guess what we did is I wrote down three specific significant errors I made in my investment career and, kind of what I learned from it. We can just go through them and talk about them. And I guess I'll go first. I started investing in the late 90s and when the dot-com boom was going on. And I was, there had the discount brokerage like E-Trade was out in like 96 or 97 is when I started. And you had this big boom and I didn't have much money, but I, was putting it into these hypey stocks, like the GameStops of the day. JDS Uniphase was probably one of the biggest positions that I had, and it tripled and then tripled again. And, and it just seemed wrong. Cause I remember one day watching CNBC in the morning in 1999 and thinking, wow, I made more money yesterday than I did working. Maybe I should just do this full time. And there was a huge amount of people that were start becoming day traders back then. I don't know if you remember,
I remember very well. My Polo Pro rented an office and bought a lot of computer equipment and subscribed to all these trading services. So when a professional athlete knows nothing gets into, yeah, of course, you're right.
Well, I knew nothing, but I was just following along. But when I realized that I could have made more money I made more money passively, basically with JDS Uniphase and a couple of others in a day than I made working that day. Realizing that it made, watching my own mind, I guess, it made me think that something was wrong. And so as things kind of continued going up and we had the Y2K worry, that people were really worried the whole world would fall apart in Y2K. In December of 1999, I sold my stocks. I just sold them because it just seemed insane to me what was happening. But come, January 1st, 2000, nothing went wrong with Y2K. And then the stocks continued to march up. The bubble did not burst in the end of 1999. It continued for another 4 months. And by March, I felt like a total idiot because the market had gone up about 30% since January and I'd missed out on it. So what did I do? I bought back into the market. And then the next month, it all fell apart. And I I basically rode JDS Uniphase basically all the way back down to where, to where it was before I bought it. So, terrible mistake on my part. And I think the lesson there is the fear of missing out. Like I knew something felt wrong to me. So I followed my gut instinct. Of course, it was an uneducated gut instinct. And then my emotions got the best of me when I felt like a total idiot for missing out on these huge gains. And so I bought back in just before it collapsed.
You made exactly the same mistake that Isaac Newton made during the South Sea bubble in England. He made a lot of money early on. He did what you did, sold out, and it kept going up. He bought back in and he lost everything and almost blew himself up.
Well, I'm glad I'm not the only one to make that mistake, but fear of missing out is a real driver. I mean, emotions are the main thing, I think, with it, or one of the big fears or worries you have to deal with in investing successfully. So what's an example of one of your worst investments, Doug?
Well, the first thing that when I thought about this was it was an error of omission as opposed to commission. And after I misallocated 4 years at Georgetown University, I came back there to go to work. And I made a big mistake. I didn't buy a house. And of course, it was stupid because Washington, D.C. was like a slam dunk sure thing. Nothing was growing as much as Washington itself. The richest counties in the US are all around Washington. It's full of rich lawyers and lobbyists. So of course there was going to be a long-term run on nice houses. So I didn't do it. So why didn't I do it? Why didn't I buy a house in DC when I lived there for years, for a couple of decades, like an idiot? Well, first of all, I didn't like the people around there. So it was a double mistake. I really didn't want to buy a house because a house ties you to wherever it is, at least much more than renting does. And the second thing, in the early 80s, and of course, prices were reasonable then because mortgages at that time, you were paying 10, 12% for mortgages. It made it rather expensive. But it was a fear of nuclear war. And a lot of people have forgotten that during the early to mid 80s, there was there was a lot of chatter in the air that the Russians might strike, or the Americans might strike with Reagan's Star Wars routines. And I said, gee, I don't really want to be in the epicenter when they try to decapitate the snake. Washington would have been a prime target, of course. It would have been nothing but a smoking hole in the ground. So anyway, it was a mistake not buying a house in DC, because I would have gotten 10 for 1 on my money with a 20% down mortgage.
Well, and you've done very well with a lot of real estate all over the world. So that it is kind of weird that in that spot where you had a hole for a long time, you didn't bother to buy a beautiful home there. Yeah.
Yeah. Well, real estate's been very, very good to me, but not in Washington. Anyway, it was a mistake. I mean, confused thinking on a number of levels. So
that's another one.
Go ahead.
Okay. So for me, the biggest single mistake I made was in another big market turn in the global financial crisis. So I'd been reading your work leading up to that, and I knew that there was a big problem with the markets, so I sold all my stocks, and I actually sold my business then, and I moved to Argentina, and I was sure that the world was going to fall apart. I think I met you in October of 2007 when I was down there to buy an apartment in Buenos Aires. And by then I'd already sold my stocks and sold my business, and was just kind of, expecting a big financial crisis because of the housing market and so forth. In any case, so I was right about that. And I thought that gold would go up in value, that in a crisis that was coming, gold would go up in value. And so I didn't just buy gold itself. I bought something I didn't understand very well, which was gold futures. And they're pretty substantially leveraged, but for about $5,000 or so, you can control, 100 ounces of gold. And so you can get incredible leverage on it. It's something like that. I don't know what it is exactly today, but it's something like that. And so, I expected a financial crisis, was right about that. I expected gold would go up, and ultimately, I guess that did happen, but in the short term, it went down a lot. And so I bought it in a leveraged instrument that essentially, once the turmoil really started and gold got hammered like everything did, essentially, I had margin call after margin call, and I took what was a small speculation, basically, that gold would go up. That would have made me much more wealthy if it had worked. Ended up being something that almost bankrupted me because I kept meeting the capital calls on it, every time it came. So I didn't understand the instrument. I just kind of stayed with a bad trade too long. And ultimately, when gold bottomed out and, I met my last capital call, as soon as it got backed up to where I was basically even, I sold. And really, I was happy to get out with nothing.
That's right. First rule of a Tyro investor: get out even.
Yeah.
Your lost position.
And I was very lucky though but I didn't understand the asset really. I didn't understand futures investing or trading. I didn't really understand that. I didn't really think of it properly in terms of it being a speculation and not something that you have to limit your risk exposure on. And I just rode the trade all the way down, and it could have, would have gone 2 more weeks into the negative, I wouldn't have had enough cash to be able to survive it. So it was really, really close.
Well, one of the first rules of commodity trading is never meet a margin call, and kind of ties into another old saying. Harry Schultz popularized this more than anybody else, I guess. He says, "I'm often wrong, but never for more than 24 hours." Yes. Good advice when you're trading futures. Absolutely.
Absolutely.
But that's not dissimilar in a way to an early mistake I made. I got into gold stocks after I read Harry Brown's How to Profit from the Coming Devaluation, which I read in '71 at about the time of the devaluation itself. And started buying gold stocks. Didn't have much money back then, not much money at all, quite frankly, but I did. And started making a lot of money in these gold stocks because there was a huge bull market in them from '71 to '74. And by the time the peak came in 74, I was making more money and I was buying more of them, but they started going down. And I didn't know, and I didn't realize that the trend had changed. And, typically, this is the way it works, lost almost everything that I'd gained earlier. And there was a doctor that I knew in Washington, D.C., who was a trader at the same time. And he drew this to my attention. He showed me, look, we were discussing this one time. And he said, look at these charts. And it was clear that the charts of all these, they were South African mining stocks. That's what we were playing with mostly at that time, going up. And they started going down. And he said, the trend has changed. And I'm not a chartist. I don't believe in head and shoulders tops and flags and double bottoms and all this kind of thing that the chartists have. It's mostly witchcraft, that type of thing. But I do like to look at charts to see what the general trend is.
Yeah.
And at that point, that was a hard lesson. And I always look at charts just to see what is the trend, where have they been, and where do they seem to be moving now, just as a starting point for analysis.
Right. Because I think one of the things is that you get you become a believer in your trade. You have to obviously to put your hard-earned money at risk. So if you don't, you have to believe in the trade, and the more the trade works for you, the more you become a believer in it. And it can become ideological. And we've seen that with people in some of our comments talking about gold and talking about Bitcoin and, and other things where they just it's ideological. It's not about the trend, or it's not about, the current speculation or anything.
I read a comment in one of our conversations where somebody was whining about, well, I can't believe anything Casey says because he doesn't believe gold is manipulated.
Yes.
And well, that's a statement of ideology, not investment fact. And just to speak very briefly, is gold manipulated? Everything's manipulated. Everybody tries to manipulate everything. That's just the nature of life on this planet, okay? But that would almost be a separate show talking about that. And I'm sure I'm going to make some enemies when I come up with my view, because in point of fact, I don't think the powers that be really give a damn about gold, but another question entirely. So, okay.
All right. So my last one is, and it's not a specific investment because because I don't want to name the name of it, but it's about private deals. These are private investments in non-public companies, and they're just in general an awful idea. They really are. And I've invested in a bunch of these as an angel investor, and some of them have definitely worked out. But the reality is that if you're a minority shareholder in a privately held company, without good opportunity, without a clear path to liquidity very soon, where you can at least get out of it, then it's almost always an awful investment. And, you can't, as a minority, again, you can't demand, the books, you can't see how the company's doing. You have no way to affect change in it. And your money's, probably never going to see it again if you invest in private deals. And so I know a lot of people think that works, or that's how you make money. But, and I know you do private deals, but private deals of public companies or companies that will soon go public.
Yeah, exactly.
Oh.
Yeah, you're absolutely right about private companies. There are so many pitfalls about them, and the odds are against you, and everybody knows, if I'd invested in this, you're absolutely right. It's an area for the extremely lucky or the truly expert investor. No question about that. The next thing I had on my list was not holding on to winners long enough. I've been a car guy my whole life. At this point, don't care about them as much as I did for a number of reasons. But I was an early believer in Shelby Cobras, which are still the most fun to drive cars of any era, as far as I'm concerned, even though the technology on them is 50, 60 years old at this point. So I had 3 Cobras from the 60s, 2 289 Cobras and a 427 Cobra. And I realized that those cars were gems when I had them. They were just I bought them as used cars. They were just used cars. That's all they were. Snappy, snazzy, but who gave a damn? And those cars, which at that time, you could buy a 289 Cobra or a 427 for in the late 60s, let's say 5,000, maybe $6,000. That was a lot of money for a car, no question about it back then. A lot of money was what a Cadillac cost,
Yeah.
frankly. But if I'd held on to those cars, just put them up on blocks in a garage, they'd be worth $1 million to $2 million a piece now. That would have been a super investment, better than Berkshire Hathaway.
Have you seen the movie Ford versus Ferrari?
Great movie, yeah.
I want to make sure you'd seen that because that was fantastic. I thought that was really.
It was great. And I still, although it would be somewhat unseemly for somebody, in his 70s, and everybody gets decrepit in their 70s, quite frankly, but I'm still tempted to go out and buy a 289 Cobra just because they're absolutely the most fun that you can have with your clothes on, with the possible exception of playing polo.
289 Cobra, like what year is the ultimate year for that?
65. 66, they came out with the 427 Cobras. The 289s were much more fun than the 289s, than the 427s. And I think they're prettier and they're almost as fast. So, but they make, there are replicas made of them today. And you can get a replica that is really, I understand, haven't driven one, but I'm tempted to go out and try one. What is the name of the group that makes the replica Cobras? There are a number of them, and they're supposed to be really just as good as the originals, except with modern technology. So, for what it's worth,
power steering and anti-lock brakes, that kind of thing.
Things of that nature. Maybe not anti-lock. I don't know what they've got on them, but those were primitive cars. But boy, were they fun. I mean, I remember. It was so enjoyable putting my 289 Cobra sideways all the way through first gear before you hit second. Can't do that with cars today.
Yeah, they won't let you. They autocorrect. You have to, even when you turn off all of the, in my BMW, I turn off all of the traction control and everything, and it still is really hard to get it to the back end to break out, to drift or do anything like that, because it does keep some level of stability system in place, so.
Yeah. And like my favorite 289, I took it to the drag strip occasionally, and it would typically do about 13.5 at 105 miles an hour through the quarter mile. Well, that's still fast today. It was really fast back then, but nothing like what cars do today. I mean, all kinds of cars. I mean, your BMW, which is just a sedan, will do better than that.
Yeah, I don't know what the quarter mile time on it is, but it's 0 to 60 and I think 3.5.
Pretty good for a 4-door sedan.
It's amazing.
Yeah, things have changed.
Anyway, but I'm sure that the Cobra is more fun to drive, to be honest, because it's just got too much.
Held on to them, and of course, a trend that was logical, and I saw building, was that muscle cars from the late 60s, before they were federalized and starting in 1971 with pollution controls and all kinds of, the bumpers came and all this type of thing. But actually, I might not have called this one. It was that there was a car back then, which Dodge is making today, kind of a factory replica, the Dodge Challenger. And I remember watching an auction on Barrett's or Goodings, one of the groups that do auctions. And one of them, it was a 1970 426 Hemi convertible with all the little bells and whistles, went for $2 million several years ago. $2 million for an old muscle car.
That's crazy.
Shocking. So, I mean,
how do you know when you have
about these things and you can see quality, what other people want? Yeah, you can buy something like that and put it up on blocks. But it's too late for that. I mean, there's a bubble today in exotic cars where everybody that wants a Ferrari or a Lamborghini, and there's a dozen brands that they're being cranked out by the thousands by the factories now. So And people are paying outrageous amounts of money thinking they're instant collectibles. This is so totally different than it was back then. My guess is that in 10 years or 20 years, certainly, most of these, newly minted Ferraris and Lamborghinis and God knows, there's a dozen others. They're going to be up on blocks with dead batteries and birds roosting in the engine compartment. That's what's going to happen to them. We'll see. Famous last words prediction.
What do you think, though? How do you know when you have a winner, when you're holding it, though? And like, how do you recognize that you've got a winner and that selling it is a mistake? Maybe with the cars, you could see the quality of them and, you liked them and they were fun for you to own, but with the stock, how do you keep that same?
Stock is a different thing. Well, God, that's a whole different, because other mistakes that I've made that actually speak to that question is that in my newsletter, which I started that newsletter in November of 1979, and one of the early recommendations, or a couple of them actually, that I wrote a lot about were government bonds. I mean, investment, bonds, but government bonds, long-term treasuries were yielding, you could get 15% on them. And you could buy a government bond at like an 8% coupon. You could buy it for like 65 or something like that. And frankly, one thing that Richard Russell, who many of our listeners won't know who he is, but he wrote the Dow Theory letters for many, many years. And he was a very wise and very shrewd and very rich guy who in his letter just talked about what he was doing and what he was thinking. And one thing that Dick always used to say is income is really important. As time goes on, you become more and more interested in income. It's certain, it takes the worry out of being, all kinds of things. And, frankly, if I just bought and held, I bought them, but then I sold them when I figured interest rates had bottomed. When it went from 12 to 8%, I figured it was time to dump them. Of course, that was a mistake. But, I could have and should have just held on to those treasury bonds because I could have borrowed against them and gotten 90% margin, which is what they offered then. I don't know what they offer now on government securities, which were considered as good as cash. So should have done that. Should have let the trend be my friend and not second guess myself. I could at this point tell my favorite financial joke, which has to do with interest rates, or is that appropriate?
Yeah, let's hear it.
Oh, okay. So Einstein dies and goes to heaven. And St. Peter greets him and welcomes him and says, Mr. Einstein, glad to have you. But for obvious reasons, we're a centrally managed economy here in heaven, and we have a temporary housing shortage. So you're going to have to bunk with 3 other guys until your own digs are ready. He says, fine, no problem. Einstein meets his 3 roommates. They're all triple pleased that he was going to be there. And the first one comes up and says, Mr. Einstein, I have an IQ of 130, and I want to get to know you better. So Einstein says, good. After lunch, let's bounce around a few concepts of astrophysics I have on my mind. Second guy comes up and says, Mr. Einstein, I'm not as smart as that first guy. I've only got an IQ of 100, but I still want to get to know you. So Einstein says, well, let me put my grip away and let's play a game of chess. Third guy says, I'm not as smart as those other 2 guys. I've only got an IQ of 70, but I still want to get to know you. So Einstein says, so where do you think interest rates are going?
You never know.
No, you never know.
Yeah.
So anyway, bonds in the early 80s and utility stocks. Fun fact, in my book, Strategic Investing, which is still a good read, incidentally, I recommended utilities. I had a whole chapter on electrical utilities. Why? Because they were yielding, on average, 15% in current dividends when that book came out. I had a whole chapter on it, 15%. And of course, they went way up from then. So bargains like that occur occasionally. There's no bargains like that out there now, incidentally, anywhere. Well, almost anywhere. We could talk about that at a different time, but not like that.
Income.
And what's the one I got here? I got, sometimes this is a mistake I tend to make. It's holding stuff too long. Sometimes you sell too soon. Sometimes you hold on to it too long. That's why you have to look at the chart and see, ask yourself, is the trend changing? Is there something I'm missing that the market sees? Anyway, well, and then my last fault that I thought of is after I sell and take a big profit on something, I find that I have a tendency to let the cash burn a hole in my pocket. And rather than letting the cash sit there and act like a crocodile on the bank, just waiting for prey to come by or waiting for a leopard, just wait patiently, get back into the market with a different deal. Big mistake. After you've made a lot of money, wait a minute, if I've made a lot of money, maybe the market's already gotten too high. Maybe, even though cash is a diminishing asset at the rate now of 5 to 10% per year, who knows? Just maybe sit in cash. It's better to lose 5 or 10% for sure than lose 50 or 90%.
Right. Well, and then have that dry powder, as they call it, available, so that if you're that crocodile, on the on the river shore, that like when the gazelle runs by, buffalo tries to cross or whatever, like you've got it there to take something out easily, something that's an easy win.
Yeah, exactly. So word to the wise, to the Robin Hood guys. I mean, hey, you made a lot of money, you got lucky. Okay, just take it off the table and just watch for a while.
Exactly. Yeah. All right. Well, good. Well, we'll leave it at that for today, and Q&A tomorrow. And then like you said, we got Gary North next week. So that'll be a lot of fun.
Super.
Thanks, Doug.